Hi, welcome back to Wesbury 101. I'm Brian Wesbury, Chief Economist at First Trust Portfolios. We're in Wheaton, Illinois. Remember, we want to be the antidote to conventional wisdom. Well, conventional wisdom is still bummed out, and part of the reason is that the stock market hasn't reacted like they wanted it to the Scott Brown victory in Massachusetts. I, however, do believe that the Scott Brown victory was a watershed event. It was kind of a 1994 event, but it's going to take some time to play out. The market was probably due for a correction, so don't overread the correction in the marketplace. Many people, however, are tying it to President Obama's proposals to deal with too big to fail financial institutions. It's obvious that we probably need some kind of legislation or some kind of thinking in this arena. Lehman Brothers, Bear Stearns, Bank of America, Citi, in the middle of the crisis, people were worried about whether they were going to take down the entire system. Whether or not they would, the government was going to come in to save them anyway because they were just so big and so interconnected. That was the argument they used for AIG. So the question is, should they or shouldn't they do that? That's one question. However, I think there's a series of questions that aren't being addressed. In fact, many times being ignored. And that is the root of the financial problem in the first place. My belief is that we would have never had a housing bubble, overinvestment in housing, if the Federal Reserve had not held interest rates down at 1%. Remember, Alan Greenspan was the chairman of the Federal Reserve back in 2002, 2003, 2004, and Ben Bernanke was a very influential governor on the board of the Federal Reserve as well. He argued that there was a global savings glut, that interest rates should be low, and that in fact that's not why we had a bubble. It was because of exotic mortgage interest rates, mortgage instruments, and the like. I believe that if they would have held interest rates up at 4 to 5%, which is what the nominal GDP rule, the Wesbury rule, if you will, says they should have been doing, we would not have had those exotic instruments. We would not have had the housing bubble or the overinvestment in housing at that time. The way to fix this problem is not to then deal with the banks later. The way to fix it is to have the Federal Reserve focus on a price rule for money. A gold standard is what Jack Kemp would argue for. The Taylor rule, named after John Taylor from Stanford, would be another way to do this. Any of these would be better than having 10, 12 people sitting around a table in Washington, D.C. trying to determine what interest rates are, because they often will be wrong about those interest rates. And I believe they were seriously wrong about the level of rates that was appropriate back in the early 2000s. The second thing that needs to be addressed still to this day is mark-to-market accounting. I believe that the bubble created by low Federal Reserve interest rates created bad loans in the system, and then once those loans started to go bad, the mark-to-market accounting rules turned what was a problem, an issue, a small fire, if you will, into a roaring blaze. It was like throwing gasoline on the fire. We need to address mark-to-market accounting. Right now, it has been reordered. We didn't suspend mark-to-market, but what we did is we allowed institutions to use cash flow to value their securities. However, as long as that rule is still on the books, so to speak, it can come back. I don't think we're going to get securitized assets back until we fully suspend, drive a stake through the heart of mark-to-market accounting. And so to really get the financial system away from kind of an edge, an abyss that many people are worried that it will fall into, I believe we have to deal with those two issues, the Federal Reserve and mark-to-market accounting. The issues of too big to fail institutions, they're serious. There's no doubt about it. I wish we would say we're never going to save any kind of institution that gets in trouble. That would be the way to deal with it, because the bigger an institution got, the riskier it got, the more walking on eggshells its investors would feel, and as a result, the market would take care of these issues. Having the government in this role of trying to save the economy and having the economy put on the edge because of mistakes by the Federal Reserve and a bad accounting rule, that is a mixture that's calling for disaster. So my view is that focusing on too big to fail is It's good. I'm glad we're talking about it, but it's the wrong focus. We should be focusing on the Federal Reserve and mark-to-market accounting. That's what created our problem and turned it into a catastrophe in 2007, 2008. By the way, just to add, I raised our forecast, as we said last time, to 13,000 on the Dow by the end of 2010. So we remain optimistic. We continue to look for a V-shaped recovery. Good luck and good trading. Remember, we want to be the antidote to conventional wisdom. See you next time.